If you think interest rate is the most important item or term in a senior loan, then you've already started negotiating the wrong deal. What covenants really are, what founders hear and think are restrictions. Senior lenders, they hear covenants and they hear early warning systems. See how there's a big disconnect there? Covenants exist for one reason. Well, they usually exist for one reason. I've been involved in some scenarios where the covenants actually existed because they intentionally wanted the borrower to not accept the loan terms. That's a whole different thing. But they are not there to punish borrowers. They are there to be tripwires. There's a couple types of covenants. There's two that really matter for our purposes. I'm going to simplify this as much as I can without dumbing it down. There are financial covenants, and those measure performance drift, right? Common examples are going to be like leverage ratio, fixed charge coverage, minimum liquidity, debt service coverage. If you've done any real estate, you've surely seen DSCR loans that are based entirely on debt service coverage ratios. What they're really asking is this business deteriorating faster than we expected? If you miss one and the lender doesn't panic, they lean forward, right? And that's the idea. They're going to measure these things over time to see the direction that the business is going. Number two type of covenant are going to be affirmative and negative covenants. And these are going to measure behavioral risk. They restrict things like additional debt, asset sales, dividends, M&A, CapEx explosions. And the reason why is because most credit losses don't come from markets. I mean, some do, but we have the Fed to step in and save everybody for that. But in all seriousness, they usually come from market decisions that were made under stress, right?